Okay, so hey, it's Levi here. Just wanted to talk a little bit today about different multifamily financing options and what to use when, depending on what your business model is, your hold period. So we'll just go ahead and jump right in. Okay, so we can go ahead and get started. So for those of you that are kind of just getting started into real estate, you might not have a lot of experience. Definitely the easiest loans to get is going through a local bank or a credit union. However, they are recourse, meaning that if you were to default on the loan, not only could they take back the property, but they could come after your personal assets. And as far as terms go, 5 years is the most common with a 20 to 25-year amortization. However, if you ask, you can get 7 years, and I've even been able to get 10 years before if you do a little negotiating. Um, and then 1 year of interest only. I've been able to get that. I've heard of other people being able to get that. I've never heard of more than that. Um, and then as far as the interest rate, it's typically a 2.25 to 2.5, sometimes even closer to 3% spread over the LIBOR rate. So it is a little bit more expensive than some of the other permanent financing options, but still fairly low if you compare it to a bridge loan product. And then as far as the debt service coverage ratio, so that's your net operating income divided by the debt service, the monthly principal and interest payments. So your NOI has got to be at least 1.3 over the debt service. So that is a little bit higher as well than some other permanent financing options. Prepayment penalties, what's nice is there is none. So this works great for getting in and getting out, whether you're flipping or you're going to be refinancing into more permanent financing. As far as qualifying for the loan, it's typically you got to have a net worth equal to or greater than the loan amount and 10% or more liquidity of the loan amount. And that is post close. So after you put in the down payment, closing costs, everything, you need to have 10% liquidity post close. And there's a few like revolving lines of credit that counts as liquidity. There's a few different options just besides actual cash in a bank account. And then so bridge financing. The good thing about bridge financing is there's some products that you can get that are non-recourse, and then the terms are typically 1 to 5 years with some extensions as options. So like what's really common is a 2 year term with a 2 year extension, so or a 12 months extension even. So you go in and execute your business plan, whether you're remodeling upterior units or whatever you're doing. Once you get your stabilized NOI and you go to refinance into some long-term debt, then you have that extension option if your business plan were to last a little longer than what you projected. Interest only is typically over the full term, and the interest rate is a little bit higher than what you would see from a local bank or credit union or permanent financing. And then your debt service coverage ratio, they'll go all the way down to 1.0, meaning that if you there's even some products that'll go lower than that, but they'll make you set aside funds up front to be able to make the payments. Hence using a bridge loan, there's obviously the property isn't performing the way it should. That's why you're using a bridge loan. So they'll work with you a little bit on that. As far as prepayment penalties, you can have no exit fee. On our last bridge loan, we were just committed to 12 months of interest only payments, and then after those 12 months, we could exit at any time with no prepayment penalty. And then as far as qualifying for the loan, it's the same. That would be, equal to or greater than the loan amount and net worth. That's divided amongst all of your key principals on the loan. So you can always bring on another partner with a higher net worth to help you qualify for that. So now we're going to talk about permanent financing, some agency loans, Fannie Mae and Freddie Mac. Um, a little bit later on, maybe in another video, we can talk about life insurance companies and HUD loans. HUD loans are great for cash flow. You can get 35 to 40 year fully amortized loans, so it's fixed for the full 35 to 40 years. And interest rates are like 50 to 100 basis points lower than agency loans as well. But as far as Fannie Mae and Freddie Mac go, they are non-recourse, so that's definitely nice, especially if you're looking to bring on another partner to help you qualify for the loan, meeting the net worth and liquidity requirements. As far as the terms go, it's 5, 7, 10, or 12-year terms, and that's amortized over 30 years, so that helps a lot on your cash flow. And then interest only, you can get up to 10 years of interest only. If you cut back your leverage to 55%, you can get full 10 years of interest only. Interest only is always nice when you're executing your business plan. If you're renovating units, occupancy is going to drop down a little bit. It gives you some more buffer in your mortgage payment where you can have your revenue drop down and you're still okay. As far as the interest rates go, they base it off the 10-year treasury. So it's typically like a 1.75 to 2.5% spread over the 10-year treasury. And that is dependent on your strength as a borrower. So your net worth, liquidity, your experience, if you've owned other deals in that market, various things will determine what kind of spread you need over the 10-year. And then your debt service coverage ratio, if you're in a primary market like Miami, San Francisco, New York, Seattle, it's a 1.2 debt service. If you're in a secondary market like Salt Lake City, Denver, Colorado, it's a 1.25 debt service. And if you're in a tertiary market, a smaller city like less than 200,000 population, you're going to need a 1.3, maybe even a 1.35. Typically, the smaller the market, there's less employers, there's less diversification. It's just not as strong, and they want to have more income, over your debt service, just to give more buffer for your rents to drop. If people lose jobs, employment goes up. And then as far as prepayment penalties, so agency loans, you're always going to have a prepayment penalty. If you do a floating rate, you can just have a 1% exit fee. So that is kind of nice. But for the most part, if you're getting an agency loan, you're going to be planning on holding this thing at least for a few years. You can get a step down prepay, which is like if you're doing a 5-year term, 5, 4, 3, 2, 1. If you're doing a 10-year term, it's 10. It's 10, 10, 9, 9, 8, 8, etc. down. So they're less brutal than the yield maintenance, but it's still a pretty hefty prepayment penalty if you're planning on selling or refinancing in the near future. But what you can do for Fannie Mae, you can get a supplemental loan and keep the existing loan. That way you can still pull some equity back out. Or if you're selling the property, you can have your buyer assume that loan and get a supplemental to leverage back up. And loan qualifications are the same as what we've talked about in the past. But yeah, here's just a few different options that you have. So depending on what kind of your business plan looks like, what you're looking to do with the property, how long you're looking to hold it, it's going to depend on what kind of loan product fits your model best. And I'm not a loan officer. I'm not looking to get business. I'm just trying to provide information on, what I've learned, just, working knowledge. And if you have any questions about this, feel free to reach out to me. You can send me an email at levi@wealthcreationmgmt.com, or send me a DM, and I'd be happy to help.